But generally speaking, for investment properties, there are a couple of different approaches. One is I think of, who's it attainable for? I think of young kids who are starting out. And if you want to be an investment property owner, if that's kind of your vision, your dream of how to build wealth, how to build passive income, and a lot of people are big believers in that. Mm-hmm. It is very attainable, and you do that by acquiring properties as a primary residence, and then you hold it for the required year.
So just very fundamentally, in case there are any people who need that distinction, why does it matter that you get it as a primary residence?
Oh yeah, because we're talking about people young and presumably not a lot of cash, right? That let's say you're coming out of college, you just got your first job, maybe a year into it, and you just haven't had time to accumulate a lot of cash. Then, primary residence, you can finance a primary residence. You can finance a primary residence for as little as $0 down, depending on your circumstances. But anybody can finance it with an FHA loan, 3.5% down, or conventional loan. First-time home buyer, 3% down. Mm-hmm. And so, for two reasons, that's a great way to do it. Is because A, that you don't have to accumulate a lot of cash, which you probably don't have a lot of, and B, it's just a lot cheaper money. If you're financing it as a primary residence, right. It's a lot cheaper money. And the other thing is that you can get into multifamily investing. Even as someone with very little cash, if you're willing to live in the place, you can buy a 2-unit, a 3-unit, a 4-unit property.
What's the difference in cash that you would need on a primary versus
a multi? You mean it's like a single family versus a multifamily, or a primary versus investment?
Yeah, an investment loan.
So investment, I'm seeing here, like on conventional, it goes to 25% down is the minimum amount down. Oh, that's on 2 units. No, 85% on a purchase. So on investment property, if an investment is being contrasted with primary, mm-hmm. It's a rental property, and you're not occupying it anyway. You can buy a duplex and occupy half of it, and that's a primary residence, and you get all the primary benefits. But this is a pure investment property. You have to put a minimum of 15% down on conventional, and you can't use FHA for it because FHA is not for investment property. And so it's...
Why did I think it was 25%? Is that...
for investment?
Yeah.
Because there are substantial price breaks if you can get to 25% down. The costs are rise sharply if you put less than 25% down mm-hmm. on an investment property. And so we really, a lot of people really try and get to that level. And
because it's hard to make it cash flow if
or just the cost of money is very expensive. You just want to save that that extra interest and fees that you pay in order to get it with less than that down.
Yeah.
So really, kind of to answer your, go back kind of your original question, who's it attainable for?
Yeah.
It really is attainable if you can, if you can afford a house. It's a primary residence, and you can potentially get started investing in investment properties. And basically, your plan would be to finance it as a primary and hold it for the minimum required 1 year,
mm-hmm.
and then
live in it.
Yeah, live in it exactly for the minimum required 1 year, and then you can sell that, or retain that as an investment property, convert it to investment property, and do it again. And so, or you can do it as you can buy a multiplex, and this is a way for people, maybe even who couldn't qualify for buying a house on their own, but if you buy a duplex. Mm-hmm. Owner occupied, and you've had a history of having some rental expense. If you've had no rental expense, then underwriting guidelines won't allow you to use any of the rental income of the second half.
Someone who has a not massive income amount, or they can't show a qualifying income amount necessary for just a regular single family that they're going to live in, but when you get a multifamily, you can use the rental income and count it as your qualifying income.
Right. Now,
If what was the stipulation?
If you've had rental expense in the past, okay, if you've had zero rental, if you don't own a property, you've had zero rental expense, then generally they're not going to allow you to use that rental income to qualify. Now, I need to add a caveat there. The minimum down payment for a duplex conventional loan is 15%. And so that's a much higher step up in terms of the amount of cash that's required. You can still do FHA for a lower down payment, but
because 3% on a single family versus 15%.
Right, that's a huge difference in the cash investment required. But I do believe FHA will still qualify you with the rental income. I'm going to need to double check that, and I will try and do that before you get this episode up, so you can kind of clarify that.
So it's FHA will do multifamily, but if you're going to live in it, but it's 15%, not 3.5%.
No, FHA is the 3.5%.
Oh, okay.
Yeah, so you can get into an FHA with as little as 3.5% down on a duplex.
So requirements are, if you have to be living in it.
Correct. At least half of it if it's a multiplex.
Okay. Yeah. You don't have to bounce between the the rooms.
Man cave.
Yeah.
Second unit. Yeah.
And then the rental expense, you were saying basically you have to have some proof that you've paid rent before. Like you can't come from living for free at your parents'.
That's the conventional side of qualifying with rental income. FHA, I need to double check that.
Okay. Yeah. But there's some definitely, like, there's a fairly low barrier, but there's some stipulations to be aware of, that it's not just universal, anyone and everyone that applies to.
Right.
Got it. Okay. So can you clarify the other route? So that was one route you were talking about. Say you're a first-time home buyer, a young guy, and you just decide to go to the route of, I'm going to get a multifamily and rent out the other units. The other route you were talking about was buy it, live in it for a year. Buy a single family, live in it for a year. What does that look like then? What are the benefits of that? What's involved in? Yeah, can you then move into a renting situation where you're renting and then you're renting out your place, or do you have to be? Yeah, I mean,
So you can definitely, that scenario that you're describing is just, basically you're just financing a property as an owner-occupied property.
Because that's how you bought it.
Because that's you're buying it, you're financing it as owner-occupied, and then your plan is to move and then hold it as a rental, rent it out, move out of it. When you buy a property and you finance it as a primary residence, you're stating explicitly on the deed of trust that it's your intent to occupy the property as a primary residence for at least a year. And the key there is intent. That has to be honest, or it would be loan fraud. Your intent has to be honest, but intent doesn't always translate into action, right? So if something
doesn't
comes
mean
up,
you're necessarily going to get in trouble if you move.
Right.
6 months
People.
later.
I think that's a lot of. There's a misunderstanding around that. A lot of people think, well, something happened in life. My job got transferred. Divorce. All kinds of things happen that you didn't plan when you entered into the property with honest intent to occupy it for a year. Things happen, and so there's nothing wrong with then moving out of that place before that year is up. But you just have to be aware of the fact that that the reasons for that will reflect upon your original intent.
Right.
Will either validate that or not validate that original intent. But basically, you buy it, you occupy it for a year as a primary residence, and then you can move on to the next one. Now, yes, you can move into a rental, right?
Okay.
Because there's no obligation.
Like if you wanted to start getting the revenue from that, but you didn't have the cash to buy a
next one
place.
Yeah.
There's some trade-off there of obviously renting and then trying to make income.
Right.
Yeah.
Yeah.
So not sure it's the wisest decision, but you could.
But you could. There's nothing restricting you from doing that.
Yeah.
When you move into that next property. But more typically, what people who are kind of following that strategy are going to want to do is say, okay, I'm going to use that year to save up for that small amount of down payment that I need and buy another primary. And so it's possible to be become a serial purchaser of investment properties at a relatively young age, without laying out a bunch of capital.
So could
because
you
you're buying these
quantify
primary residences?
Quantify like what you mean by a small amount of like, because I think it's helpful to hear the actual numbers. Say the first property is, let's use Seattle numbers. Say the first property is $500,000.
Yeah.
So cash wise, obviously tons of variables, but you could do it with around $30,000 in cash.
Well, you could fairly easily do it with 15, 20. Let's say 20, because that's 3% down.
Mm-hmm. It's 15
plus 5,000 for closing cost prepays or whatever.
Okay.
So you could do it for 20, and potentially less. I mean, there are ways obviously to negotiate, depending on the market you're in. Can you negotiate seller to pay for your closing costs?
Yeah.
If you find a property that's been sitting, and nowadays you can. This wasn't true, a year ago or 18 months ago. There was no chance of getting a seller contribution, but now there's a little bit more of a mix. Properties are still in demand. They're still low supply, low inventory, but there is more of a mix, and there are properties that have been sitting for a while. So you can go and say, instead of asking for a $15,000 price reduction, you can pay full price and ask for $15,000 in closing costs and prepays or whatever.
So then you're down to
so then you're just bringing your down payment to the table, and so
you're looking at like 15, 20, 25 around here for these prices, for $500,000 house for your first, for what you need cash wise for the first one.
Right.
And then next down payment you'd have to be at 5%.
Because you're no longer a first-time home buyer. Now, or you could be 3.5% FHA potentially.
Okay. Yeah.
So and you could also potentially.
So you need to save up
Or get a home equity line of credit. Let's say you have some appreciation on that property during the course of the year. Now, doing this every year and you're putting low money down,
you're trying to do it.
Getting to the point where you have enough equity to use it, to tap into that with a home equity line of credit on the existing house, to put it down in the next house, might be a challenge. But that is something to think about.
If you get the home equity line of credit, you can still keep your original primary residence mortgage.
Yeah.
You can get a HELOC even though it won't be your primary residence.
Yeah, because that's a great question. Because and we do this all the time with people who are looking to transition from one house to another and buy another one first, but temporarily hold on to the old one first. You can't go tap into the equity on the old house with a new primary residence first mortgage refinance because of that clause that we talked about earlier. You're explicitly telling the lender, whether you're purchasing it or refinancing it, that's your intent to occupy that property for a year. And if you're taking that cash out of that property in order to buy that next one that you're going to live in, then you obviously can't say that.
Right.
If that's going to happen pretty quickly. But a HELOC contains, home equity line of credit or HELOC contains no such restrictions.
And it's probably a little bit higher rate than like a primary residence, but it's short term.
Yeah.
The way
typically
you're using it.
This is typically short-term money. And you don't. There's nothing in the deed. There's nothing in the documents that all you're declaring is I'm using it presently as a primary residence.
Yeah.
So you can plan to sell it next month. That's fine. And I've been explicit with this with the banks when I go to them. I say this is my plan, and this is what I'm going to recommend to my clients. I'm going to tell them to get a HELOC from you. Are you okay with that? Because I know you don't necessarily go into these HELOCs wanting them to be in existence for 3 months and then go away, but that's kind of how we're going to use it here, and I've always been able to do that. Yeah.
So HELOC, or say you're going the conventional route and going 5% down on that. You lived in your house for a year, you go to that next house, you're looking at about 35.
Yeah, because you have 5% down.
Yeah. If you're staying in the same level house.
Yeah,
if you're going
500 to 500.
750, then obviously that's going to go up a little bit. But I think it's helpful. Like, I don't know, it's still surprising to me to hear that, for just 30 grand in the first house, living it for a year, all you have to save up is, depending on your circumstances, that can be a lot to save up.
That can be a big mountain to climb.
But all you have to save up is 35 for another 500 grand, and then be owning and getting rent from the previous house.
Right.
The other piece is obviously qualifying income. So on the new house, you can use rental income from the previous from what you're going to be renting out as qualifying income, correct?
Good question. And the answer is a qualified yes. This is what's called the departing primary, right? So you're departing from this one as your primary residence, but you're still going to own it when you are financing and closing on the new home.
Right.
And because you're living in it presently, it's not rented, right? Presently.
Mm-hmm. Right.
And so
when you're getting the loan.
When you're getting the
Yeah.
loan. So generally you can use rental income to offset the mortgage on the old property, but you need to have a lease, and Fannie and Freddie have slightly different rules regarding the lease requirement, but generally you should expect to have a lease for about a year, at least a year.
Signed lease.
A year duration, and a security deposit is, and they're, they are more or less restrictive on that secondary term, whether you need a security deposit, but I would just plan on that, just to be safest, have the most options available to you on the financing of the next home. Is just, make sure you have a lease in place, make sure you have a security deposit. And if you have those things, the lease doesn't have to have started when you close in the new home, because obviously you're still living there and you haven't moved out yet. So it doesn't have to have commenced yet, but it shouldn't be 6 months out in the future.
Right. Because, for most people in that situation, you're not going to have some insane salary that's going to enable you to qualify for 2 mortgages.
Right.
On the old house and then a new mortgage on the new house. So you would probably need that lease to offset the old mortgage.
Right. Most people will.
Yeah. Okay. So you were talking about ahead of time. You had looked a little bit into the process of the logistics there and of identifying rental property opportunities. What did you see there?
Yeah. So many people may be familiar with Bigger Pockets organization. They do a lot of podcasts. They've written books. They have a lot of resources, tools, and things. And one of the things they talk about is kind of this 8-step process if you want to become an investor. And really you kind of go through this every time. It's not just for first-time investors, but it's a lot of things that people don't think about maybe when they're just thinking about becoming a landlord, becoming an investment property owner. And so kind of the first thing is pick a property type. Do you want a condo? Do you want a single family? Do you want a multifamily? So you want to kind of study a little bit about those different types of properties and what kind of property, and then pick a market. Pick a market. Where do you want to be? What markets are attractive to you? Do you want a market that's in your backyard? And obviously there's obvious benefits to that, right? To have.
Like we talked about, if you're going to be doing it as a primary residence kind of situation.
Yeah. Then
that's going to have a huge impact.
That's going to be in your backyard. But if people who are just investing, they may, and there are lots of data-driven reports available to people, relatively inexpensively, that will tell you what what rents are doing, in different markets, how much in demand, how's the supply of rental properties, how much in demand are they, what are rents doing, and that's really important, to kind of study. You may want to do a property that's outside of your immediate market. If you live in a high-cost area, and you want to be an investor, but you don't have $1 million to put on a rental property.
So that was where that was another question I wanted to ask. Say you do want to go in another area. In my head it connects. I'm not sure if it really connects on paper, but can you invest with a friend? Like, I'm thinking of if you have a friend who's in a market where they're seeing the actual properties, or maybe they're going to buy it as a primary residence. Maybe that throws a new loophole into the answer. But can you invest with a friend? Let's say both scenarios, just as an investment loan, the typical investment loan route, or if you can touch on it, can you do it as
friends
a
can be co-borrowers?
Resident?
Friends can be co-borrowers. On a rental property, if you're trying to do it as a primary, that's a lot trickier in a whole lot of levels. Because what does that mean from a rental standpoint? Are you going to collect rent from your friend for your half of the ownership, or but I have seen that. I have seen that done.
Yeah.
I had a guy who wanted to buy first and sell later, and he found the perfect property, and he wasn't doing it to be an investor. He wanted a new home for his family, and he couldn't sell first because it was that white hot market where nothing was available. So he waited to buy, but he couldn't quite qualify, and so he just had a friend co-sign for him. He had a really good friend who just says, "Sure, I'll co-sign, for you." So that was a scenario that wasn't an investment property. He was buying it as a primary. But yeah, you can buy together as as friends. You can be co-signers and finance together. But yeah, so you may want to pick a market that's outside, and there are professional management companies. I mean, there's and there's a lot of great there's a lot of great online resources now that are bringing down the cost of management, because it used to be that in order to manage a property remotely, so much you needed human interaction, involvement, boots on the ground to do just about everything. And you still obviously need, you need a good repair guy. You need those resources. But a lot of the stuff that used to have to be done by a management company, like doing background checks and creating rental agreements and collecting rents and all, a lot of that stuff's available online now. So the cost has come down. Now, still, you may want to factor in that 10% management company, which is fairly typical. Management company, if you turn over full control of the rental, you're going to pay them 10% of your gross rents. And so you should factor that in and out of if you're financing in markets that aren't your own. But I think that's certainly something you ought to think about, because those are things that tend to be trends that tend to be identifiable and usually durable. I mean, obviously life happens to every market, and things can change. But things do tend to be trending in one direction or another, and so you can look across the country and go, "Wow, this is a good market to be in."
Yeah.
There are some additional requirements or risk associated with doing that away from you, but there's a lot of upside potentially there. So pick your market. And you want to research the values, the rents, the crime, and then you need to assemble your team. You need a realtor to be involved. You need a lender. Potentially need a management company to do that, and you need a contractor. Those are kind of be your core four who you need to have available to you in order to successfully acquire the property, finance the property, manage, get the tenants in there, manage that, and then just maintain it as and then the financing. Just remember when you're financing rental property, whether the property is rented or not currently. So you could be buying a rental property from someone who's owner occupying it, and there's no rent involved in that property. But when you finance a property, you're going to have the appraiser go out, and the appraiser is going to appraise the value of the property, but they're also going to do a market rent analysis on a rental property. They don't do that if you're financing it as a private, as a primary residence. Or a second home. But if it's a rental property, they will then do an additional report called the market rent analysis, and that's what the lender's going to use. They're going to take that and take 75% of that to apply a vacancy factor and a maintenance factor. So
what do you mean they're going to take 75%?
They'll take 75%. So if the appraiser comes back and says the market the market analysis I've done says that this property will rent for $1,000 a month.
Okay.
They will give you $750 a month to offset your mortgage costs.
I see.
Okay.
I see. Gotcha.
Because they want a factor in there. Because this isn't something now if you're refinancing a property that you've been rented, and it shows up in your tax returns multiple years in a row, then they're not using that rule of thumb 25%. They've got your actual tax returns, and they're going to go, I see that you've got insurance tax, taxes, but you've also got maintenance cost and cleaning cost and attorney's fees, whatever all you tend to write off in there.
When you're getting underwritten, and you're saying they take 75% of the new property.
Of the subject property.
Possible rent for the subject property.
Yeah, they take.
So that's when you're doing it as an investment loan, not like as a primary residence.
Exactly.
Okay.
As when you're buying an investment property, you're going to do that.
Yeah, makes sense. So I'm gonna ask a little bit more practical, and we can kind of wrap up on some practical questions on the financing.
Yes.
So, obviously, the main thing, if you're listening to this right now and you have some interest here, the main thing is to start planning. Maybe you're ready to make a move on it right now, but say you're kind of in the early phases, there's some interest. Main thing is to start planning. It seems like, in order to plan well, you have to know, because there's so many different routes you could go. I hate when our call to action is talk with a mortgage professional because it sounds salesy. But you're actually looking, like, in order to make a plan well, you have to know which route you're going, you have to know what you're trying to save up for, you have to know what your options are. That is probably the start is see what it would take finance-wise. Meet with someone who can lay out the options. Is that right?
Yeah, absolutely. You're right. It does feel a little salesy when you say, okay, your call to action is call me.
Yeah.
But that really is of enormous value, and because it's so hard for you to go out there and start looking at the market and having no idea how much cash it's going to require,
right,
whether you qualify or not.
I'm just going to start saving up.
Yeah, and so spend an hour or 30 minutes with a mortgage professional first,
yeah,
and get a deeper sense of, okay, if I go this route, if I put this much down, this is what it would look like. If I put this much down, here's how much I need to save.
Yep.
Whether I would qualify or not, here's what I need to do to qualify. All of those questions, you can answer that. Within about an hour, you can have a much clearer sense. And instead of looking at an abstraction, which is kind of the idea of owning rental property and then looking at the universe of rental properties, you are going there with a real sense of, okay, at this price point, this is what it would mean. At this price point, this is what it means. Now let's go find the market. Let's go see what it looks like, what those price points look like.
Yeah.
And it also helps you then when you start looking at those markets. There are ROI calculators, cash flow calculators out there that most people are using when they're evaluating rental purchases. And you need to know the financing side of that in order to use those effectively. One of the things I've heard a couple of different people say, as I've listened to different podcasts on rental properties, and they all say that every property, is cash flow positive at the right price. And that's just something where it's super important for you to go in there knowing what that price is.
Yeah.
What's the price at which that property is cash flow positive, and knowing your financing ahead of time is crucial to doing that.
Yeah, absolutely. Yeah, that's helpful. Okay, wrapping up here, after talking it through for you, what's one thing that stands out of this is a helpful takeaway? Obviously, this is a little bit all over the board, but what do you think is just one key takeaway that would be helpful to hold on to?
Yeah, I think a key takeaway is that owning real estate is historically, consistently a winning play for you can go back 5 decades, and it's very, very few times in the history of these last 5 decades where you could have bought real estate, held it for 5 years, and lost money. So owning real estate is a proven way of building wealth, and it's not for everybody. But if you have an interest in it, it's attainable even for people of relatively modest cash resources available to you if you want. And this particular, I say young people. Anybody could do that. But young people are typically the ones who are going to be more flexible about where they live,
right,
and getting started out. Hey, I'll buy a house. I'll move a couple of times in 2 or 3 or 4 years.
Yeah, even being married, you feel less flexible to say, we'll live right next door to a random renter.
Right.
Yeah.
No, exactly. So, but the main takeaway is it's very accessible. But you won't really be able to make those decisions until you meet with a mortgage professional, kind of figure out what that would mean. If you have an interest in it, then you can figure out what that would mean for you, what kind of cash you would need to save, whether you qualify or not, or what you need to do to qualify, and then get connected with the people who you need to connect with to then start kind of finding those properties.